Hey guys, my name is Amor De Libasic from WealthLine, and today I want to talk to you about personal insurances. Now, personal insurances are one of the bedrocks of ensuring that your family has a secure and stable position in the event of the unforeseen. But potentially, because it's one of those things that's quite morbid, it's left unattended to and is swept under the rug. So today I want to teach you what are the different forms of personal insurance, what do they do, how we can think about integrating them into your financial position, some of the features and settings that are important, and then some general premises to take away when we're thinking about how to use insurance to mitigate risk. So with regard to personal insurances, there are four main insurances that we look at. The first is life, then TPD, standing for total and permanent disability, trauma insurance, also sometimes known as living insurance or critical illness insurance, and then finally income protection, also sometimes known as salary continuance insurance. Now, each of these different forms of insurance have different purposes and different roles to fill when we're taking into account how to protect someone and their family. So the purpose of life insurance is to provide a benefit in the event that someone passes away. Typically, the things that we would look at for life insurance are what debt remains, and is that debt serviceable by the surviving spouse and or family, or would it be better off to eradicate that debt? Given the family situation that we have, if one spouse passes away, to what degree will that surviving spouse be able to continue to maintain the family's cash flow needs? And is there the need for a cash flow supplement? Finally, are there any education goals, so for example, private education, university education, that need to be attended to? And are there any legacy goals that we should think about? For total and permanent disability insurance, this kicks in if you can never again work, right? So if you're in a position where it's unlikely that you're ever again going to be able to return to paid employment, total and permanent disability insurance kicks in. Again, with TPD insurance, there are some similar themes that we want to think about. For example, are there any debts that we want to clear out? Is there going to be sufficient income if that person is not working, whether or not they have an income protection policy to continue to meet the family's ongoing expenses? Are there private education needs, and do we want a cash buffer in the event of an emergency so that we have liquidity? The third form of insurance is called trauma, also known again as living insurance or critical illness insurance. These are all just different names for the same thing. Trauma insurance is event-driven insurance as opposed to outcome-driven insurance, which means the purpose of this insurance is to pay you in the event that you have a serious medical event. It doesn't necessarily need to result in a disability or death, and at our practice, we typically use it to account for medical costs. Now, the majority of trauma claims are going to be things like stroke, heart attack, and cancer. Of these three, cancer is typically the most expensive to treat, and so we generally peg our trauma need to the average cost of a cancer. The final one is income protection, also known as salary continuance insurance. Now, this kicks in if you're unable to work, and it's an income stream, i.e. it pays you a monthly benefit, as opposed to the other forms of cover, which are lump sum. They pay you a kind of one-off payment rather than a continuous income stream. Income protection doesn't require that you're never again able to work, unlike TPD. So income protection is an easier policy to claim, and it's there to provide you with an income to supplement or replace the income that you've lost as a result of you being unable to work. So these insurances all play different roles, and different people in different positions in life will have different insurance needs. Someone with a very young family will have a very different insurance need to a single person on a high income. And so insurances really need to be structured and configured around the person in question. A few things to know about insurances. There are some key terms and features that we want to understand as we start to delve into the world of insurances. The first is whether your policy is guaranteed renewable or not. So a guaranteed renewal policy means that the insurer cannot change the terms on you in a negative manner without your permission. If a policy is not guaranteed renewable, it means that either the policy features and terms and conditions can be changed in a negative manner, or that policy can simply be cancelled. So if you go into a PDS, you'll find that the vast majority of insurances that people have are not guaranteed renewable. If you simply hold an insurance policy inside of your superannuation account as default cover, if you read the PDS, you'll probably find it's not guaranteed renewable. The problem that we have with this is that we have no guarantee of what those insurance terms will look like at the point of claim. Right now, in this moment, those terms might be good and they might suit your needs. But in 10 or 15 years' time, if those terms have been eroded by successive insurers who take and then resell that policy, at the point of claim, we might have an issue. So in general, where we have the capacity to, we try and use guaranteed renewal policies. Beyond that, some of the definitions that are important would be the difference between any and own occupation insurance when it comes to income protection and TPD. So an any occupation policy will only pay you if you're unable to work in any occupation for which you're reasonably qualified or experienced. An own occupation policy will pay you if you can't work in your own occupation. So there's a far higher threshold that you have to pass to be able to claim on an any occupation policy as compared to an own occupation policy. The higher up you go on the employment ladder, the more developed your particular skill set is, the more rungs down there is to fall. And so someone that has a very specialized skill set earning quite good money might be in trouble if they have an any occupation policy and their disability causes them to be able to do their job, but they could still do some other job for which they're reasonably qualified or experienced. Another thing to be conscious of is whether we want to use stepped premiums or level premiums. There are different terminologies now that are used between insurers, and all of them seem to have chosen a different name for it. But step premiums fundamentally step up in cost over time. They start off more cost effective, and then the degree to which they increase in cost over time is more aggressive than level premiums, which start off more expensive but have a more gradual incline in price over time. So regardless of the name, if you see your policy stepping up in a kind of geometric progression, a kind of exponential, that's a stepped policy. If it's more of a straight line, even if that line is at an angle, that's a level policy. So to think about whether we want to use stepped premiums or level premiums, we first have to really think about what are we trying to achieve. We're trying to pay as little in premium over the lifetime of that policy as possible. So to make a decision between stepped and level premiums, what we have to understand is how long is it that it would take the stepped policy and the level policy to be the same cost. This is what's called the cumulative breakpoint, the intersection between the cumulative level premiums and the cumulative stepped premiums. Now, often we find that's quite a bit in the future. And so for many people, rather than utilizing level premiums, it may actually be advantageous to utilize stepped premiums and then decrease that cover over time in line with their decreasing need, rather than locking in a high level of cover in a way that looks like it's going to save you money, but you're really committing to a level of cover that it's unlikely you're going to hold, for 30 years. When we're thinking about the level of cover that people typically need, it follows a kind of U-shaped curve, an inverse U-shaped curve, where at the beginning of life you have a very low level of cover need. In the middle of life, when you have young children and are burdened with high levels of debt, you have your peak level of cover need, and then it tails off as you pay off your debts, your children grow up, and you generally become wealthier, and so you're in a position to self-insure. When we're thinking about how to structure insurances, one of the things that we should be conscious of is the decision of, do we want to hold it inside superannuation or do we want to hold these insurances outside superannuation? There's a couple of considerations here. One of them is tax and cash flow. So of the 4 types of insurance, we can hold 3-ish of them inside super. The first is life. The entirety of your life insurance policy can be held inside super. Then you have your total and permanent disability insurance. The majority of this can be held inside super, but if you have an own occupation benefit, that portion of the benefit has to be what's called flexi-linked. So the policy gets chopped up, a small part of the policy gets taken outside of super, the majority is held inside super, that own occupation part is actually held outside to avoid a conflict with the SIS Act, the Superannuation Industry Supervision Act. Trauma cannot be held inside super at all, and income protection can be held inside super. Outside of super, you can hold all of the covers. There's no restrictions on them whatsoever. Now, outside of super, the only form of cover which is tax deductible if owned personally is income protection. So if you have $1,000 worth of income protection premium, you get $1,000 worth of tax deductions at your end of your tax return. Inside of super, all of the policies that can be held inside of super are tax deductible. And so often what we'll do is we'll play around with the configuration to say, okay, well, what do we want to have inside super? Can that be combined with the salary sacrifice regime such that we're putting money into superannuation to account for at least part of the cost of this cover? And in doing so, we get an income deduction, even though that cover would classically be deductible in our personal names. There's also a cash flow advantage of putting insurances inside super. If you're not accounting for the cost of that insurance inside superannuation over time, it's a drag on the portfolio and it will have a meaningful impact on your retirement benefit when you actually go to retire. Another thing to be conscious of in that decision-making process, there are some small differences, in particular with income protection policies, on the definition of what working is and at work between superannuation and personally held policies. I won't go into too much detail on that, but a high-level analysis would basically say that inside super, it's more restrictive. To be compliant with superannuation rules, the way that certain definitions work is more restrictive. And then so on average, you're probably going to find that the income protection policy that you have in your personal name is more comprehensive. The final thing that I want to tell you is how to think about your insurances, how to structure a framework and perspective on them. So most of the things that we do when it comes to financial planning or just finance in general, the idea would be for that to have a net present value that's positive, which is to say that we would only engage in something if we thought we were going to make a profit from it. That's not true with insurances. For you, an insurance policy is a way to offload risk. For the insurer, the insurance policy is an investment. And so the positive net present value has to be with the insurer, not with you. So for you, you have a negative net present value, which means that on average, you will pay more into every insurance policy that's fairly priced than you'll claim back from it. So standard insurance theory basically says that you should only insure things that are basically catastrophic, which you can't bear to face, and then self-insure the rest. So when we look at this through the lens of personal insurances, the perspective that I would encourage people to take is to understand what's a minimum financial, groundwork or framework that they and their family would be comfortable with, and then set that as the standard for the insurances. We don't want to overinsure. We don't want to create a kind of windfall if someone passes away, but we don't want to go below a level which is reasonable for the family. And so it's a balancing act between having the right level of cover, the right level of cost, and really making it sustainable over time. So I hope that's taught you something about personal insurances. If you have any questions, leave us a comment in the comments below. As always, please like, comment, and subscribe. It really helps us with the algorithm. If you've got any questions, let me know, and have a good day.